Hey everyone, and welcome back to My Trading Reviews. Today, we're going to talk about futures trading, an exciting and potentially rewarding area of trading. If you're new to futures, don't worry. In this video, I'll break it down step by step, explaining what futures are, how they work, and some key things to watch out for. So, what exactly are futures? At their core, futures are contracts between a buyer and a seller to trade an asset at a set price on a future date. Think of it as an agreement. For example, you might agree to buy 100 barrels of oil at a fixed price 3 months from now. Traders use futures to profit from price changes without actually owning the asset. Most futures trading is speculative, meaning traders are in it for the price movements, not the physical goods. Futures trading has a lot of advantages, which is why it's become so popular. For starters, there's leverage. Futures allow you to control a large position with a small amount of capital. This amplifies your potential profits, but also increases your potential losses, so it's a double-edged sword. Another reason traders love futures is liquidity. Popular contracts are traded in high volumes. This makes it easy to enter and exit trades quickly, which is especially important for short-term traders. Futures markets are also incredibly versatile. You can trade in a variety of markets, including crude oil, gold, currencies, and even agricultural products like wheat and coffee. Each market behaves differently, so it's worth exploring which one aligns with your trading style and goals. Let's talk about how futures work. The concept is actually pretty straightforward. Futures trading uses leverage, which means you're borrowing money to control a large position. For example, if you use 10x leverage on $1,000, then you're trading as if you have $10,000. This can amplify your profits if the market moves in your favor. A 1% market increase would mean a 10% profit on your position. But keep in mind, leverage also works the other way. A 1% market drop would result in a 10% loss, which is why managing risk is so important in futures trading. To open a trade, you'll need to meet your broker's margin requirements. This is a minimum amount of money you need in your account to control your contract. Keep in mind, though, that margin calls can happen. If your account balance falls below the margin requirement, your broker may force you to add funds or close your position. Futures contracts also come in different sizes. For beginners, micro contracts are a great starting point. They're smaller versions of standard contracts, making them a safer way to learn the ropes without risking too much. When trading futures, timing is everything. Futures trading is often short-term, and your timing has to be spot on. Markets can move quickly, especially during major news events. Holding a position through these events can lead to a sudden and significant loss, so it's best to stay cautious around important economic announcements. Another important factor is contract expiration. Futures contracts have a set expiration date. If you plan to hold your position longer, you need to roll over to the next contract to avoid settlement. Many brokers automate this process, but it's still something to keep in mind. And don't forget about the fees. Futures contracts often have holding fees, especially if you keep a position for multiple days. These costs can add up, so you need to account for them when you're planning your trades. Now let's talk about risks, because this is where many beginners get caught off guard. Futures trading is all about leverage, and while it can amplify profits, it can also amplify losses. A 10% market move against you can wipe out your entire account if you're over-leveraged. This is why managing your risk is absolutely crucial. One common mistake beginners make is overtrading. With futures, the ability to trade frequently can tempt you to take unnecessary risks. Stick to a plan and avoid the trap of trying to chase every move in the market. If you're ready to start trading futures, take it slow. A great way to begin is by using micro contracts. These smaller contracts allow you to get a feel for the market without putting too much capital at risk. It's also a good idea to practice on a demo account first. This gives you a chance to test your strategies and learn the platform without any financial pressure. When you're ready to trade live, focus on risk management. Never risk more than 1% of your account on a single trade. Set stop-loss orders to limit your losses and avoid over-leveraging your positions. It's all about staying disciplined and protecting your capital. Lastly, while futures trade almost 24 hours a day, the best opportunities often come during regular market hours when volatility is higher. Pay attention to the timing of your trades and adjust your strategies accordingly. Futures trading can be an exciting way to grow your skills and potentially profit from the markets, but it's not without risks. Take time to learn the basics, practice on a demo account, and always trade with discipline. The key to success is patience and proper risk management. Are you thinking of trading futures, or have you already started? Don't forget to like this video and subscribe to My Trading Reviews for more simple and informative trading guidelines. Thanks for watching, and I'll see you in the next video.